Guys, thanks for being here.
Thank you.
So we're looking at this yield curve inversion that happened on Tuesday. A lot of recession talk surrounding it, and it being a potential recession indicator. But you're actually looking much more closely at the yield curve between the 3-month and the 10-year. What do you believe is the best indicator, and how is the Russia-Ukraine war impacting the possibility of recession?
Historically, the 3-month, 10-year yield spread has been a better predictor of recession than the 10-year, 2-year. That being said, we are seeing short-term rates move higher. We are seeing long-term rates have moved up by not by quite as much. So certainly an inverted yield curve is something to watch out for. But at this point, the yield curve is not inverted, either the 2-year or the 3-month. And I think that indicates that the economy will continue to expand. That being said, I think risks are to the downside with the Russian invasion of Ukraine, the impact of higher energy prices on the U.S. economy, the impact of slower growth, potentially recession in Europe on the U.S. economy.
So we just saw fourth quarter GDP was revised downward slightly. Inflation appears to be continuing on an upward trend, with energy prices being the catalyst. Where do you see inflation in the near term and then in the long term?
So I do think that inflation is going to move even a bit higher over the next few months. So we're still absorbing the impact of higher energy prices. We are still seeing some of these supply chain difficulties. But I think by the time we get into the second half of this year, we'll start to see inflation slow. Some of the year-over-year comparisons will look easier. I don't think that energy prices are going to see the same type of swift upward movement that we've seen over the past few months. And then I do expect that some of those supply chain difficulties that we've been experiencing will start to ease later this year. So I think we will see a slowing in inflation in the second half of 2022. It's still going to be higher than the Fed would like, and we'll see the Fed continue to raise the Fed funds rate. But I think by the time we get to the end of 2023, I think inflation should be pretty close to that 2% objective that the Fed is looking for.
All right, Gus, looking ahead, we have the big March jobs report coming up on Friday. Today, we got the ADP private payroll report, showed 455,000 jobs added, smallest gains since August. More than a third of those jobs, however, in the hospitality sector. What are you expecting on Friday, and should we be encouraged about those big gains in hospitality?
Certainly, we should be encouraged. That's the sector that was hit hardest by the pandemic. And so the fact that we're seeing a recovery there is good not only for the labor market, but also for consumer spending on services, on things like restaurants, movies, travel, that type of thing. I expect that we'll see job growth in March of 450,000 or so. That's a little bit slower than what we've experienced this year, but still very, very good. We'll see the unemployment rate tick down a little bit to 3.7% from 3.8% in February. And I think that we'll see a new peak in employment. We'll be back to our pre-recession level sometime in the third quarter of this year. So given the depths of the job losses that we experienced, we have really seen a very sharp, impressive recovery in the labor market since the worst of it a couple of years ago.
So, Gus, you think we're going to have a lower unemployment rate by the end of this year, but that inflation is going to go from 8% to 2% by the end of next year without the Fed sparking a recession?
I'm hopeful. I mean, obviously, the potential is out there, and it certainly has increased with the Russia-Ukraine crisis and the negative effects it has on growth and the fact that it is pushing inflation higher. But I still, I do think that we will see some people come back into the labor force. I think we're going to see slower job growth through the rest of this year and then again in 2023, and that will help take some of the pressure off of the labor market. So I would expect that by the time we get to early 2023, we'll see a significant slowing in wage growth, and that will help reduce inflationary pressures as well and allow the Fed to achieve that 2% objective.